Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of high-frequency trading strategies, a complete guide for traders and investors. High-frequency trading, or HFT, is a method of buying and selling financial assets at lightning speed using advanced algorithms. This strategy has reshaped financial markets, offering traders new opportunities for quick profits while raising important ethical and regulatory concerns. Some praise its efficiency and liquidity, while others question its fairness. Whether you're an investor or just curious, understanding HFT means knowing both its benefits and the risks it brings. How high-frequency trading works. At its core, high-frequency trading, HFT, is about speed and precision. It involves making thousands, if not millions, of tiny moves in the market to exploit fleeting opportunities. But how does it all come together? Let's break it down into the essential components that power HFT systems. Algorithmic foundations of HFT. High-frequency trading relies heavily on algorithms, complex lines of code that make decisions faster than any human could. These algorithms analyze market data, identify opportunities, and execute trades, all in microseconds. Their role is to detect tiny, temporary price differences across markets or assets and act on them before others do. Think of these algorithms as high-speed problem solvers. They're designed to respond to specific triggers, such as price changes, order book imbalances, or news events. For example, arbitrage opportunities. Algorithms spot price discrepancies between two markets and buy low in one while selling high in the other. Market making. Algorithms place buy and sell orders simultaneously to profit from the bid-ask spread. The speed of these algorithms is what makes HFT possible. Without them, traders would miss these razor-thin margins of profit that last mere seconds or less. Infrastructure requirements for HFT. Behind every successful HFT strategy is powerful infrastructure. This isn't just about good software, it's about an entire ecosystem of tools and systems working together seamlessly. Here's what it typically includes: ultra-fast hardware, specialized computers equipped with high-performance processors to reduce processing time. Low-latency networks. Data needs to travel quickly, often requiring direct connections to exchanges, known as colocation. Market data feeds. Real-time access to every tick and trade happening in the market. Even a tiny delay could result in losses. Sophisticated software platforms. These are used to develop and test trading algorithms in an environment as close to real markets as possible. Imagine this setup as a racing car. The hardware is the engine, the software is the computer navigation system, and the data feeds are the fuel. Without all these pieces functioning together at peak performance, an HFT strategy wouldn't stand a chance. Latency and its importance. In HFT, latency, the delay between sending an order and its execution, is everything. Even a few microseconds of lag can turn a winning trade into a losing one. That's why firms spend millions to bring latency as close to zero as possible. Why is latency so critical? Because HFT thrives on being first. For example, if two traders spot the same price gap, the one with slightly lower latency will snag the opportunity. In cases where the market reacts to news, the fastest execution wins. Companies take extreme measures to reduce latency. Some install servers directly inside exchange data centers, colocation. Others invest in fiber optic cables or microwave towers for lightning-fast data transmission. It's like a race car driver trimming weight and adding horsepower, every millisecond counts. In a world where every edge matters, managing latency effectively isn't optional. It's a key part of staying competitive. Understanding how HFT works is crucial to grasping its benefits and risks. The interplay of algorithms, high-tech infrastructure, and lightning-fast execution defines what makes HFT tick. Popular high-frequency trading strategies. High-frequency trading isn't a single approach, it's a toolbox of strategies designed for speed and precision. These methods are fine-tuned to extract profit from small price movements, often within fractions of a second. Let's explore some of the most commonly used strategies that dominate the HFT world. Market making. Market making is one of the foundational strategies in high-frequency trading. It revolves around providing liquidity by continuously placing buy, bid, and sell, ask, orders on both sides of the order book. This ensures smoother market activity and creates opportunities to profit from the bid-ask spread. Here's how it works step by step. The trader sets algorithms to post bid and ask quotes simultaneously. When another trader accepts one of these prices, the market maker earns the spread, the difference between the bid and ask price. The position is then quickly hedged to minimize risk, allowing the strategy to repeat. Think of it as a shopkeeper constantly restocking shelves and pricing items slightly higher than what they paid. Even if the profit margin on a single item is small, the volume of transactions makes it lucrative over time. In HFT, speed and accuracy are crucial because competitors are aiming for the same outcomes. Statistical arbitrage. Statistical arbitrage, often shortened to stat arb, takes advantage of pricing inefficiencies between related financial instruments. These inefficiencies may only last for a few seconds, but advanced algorithms can identify them and execute trades in moments. This strategy uses historical data and mathematical models to predict price relationships. For example, if one stock's price consistently lags behind a sector index, the algorithm notices this pattern. When the stock falls behind again, the system buys it, expecting it to catch up. Statistical arbitrage isn't limited to stocks. It applies to currencies, commodities, and derivatives too. It thrives in markets where relationships between assets are predictable. But remember, it's not foolproof. If market conditions shift or the historical relationships break down, losses can mount. Latency arbitrage. Latency arbitrage is all about being first. This strategy takes advantage of tiny delays in market data between trading venues. Even a few microseconds can create opportunities for profit. Here's an example. An HFT firm notices a price for stock A on Exchange 1 hasn't updated yet, while Exchange 2 already reflects new information. The firm quickly buys or sells the stock on Exchange 1, knowing it can profit from the price catch-up. Reducing latency, or the time it takes for data to travel, is key. Firms spend heavily on infrastructure like microwave towers and high-speed data centers to shave off microseconds. It's like having a faster car in a drag race. Even the slightest edge can lead to big rewards. Momentum ignition. Momentum ignition is a high-frequency trading strategy aimed at sparking a chain reaction in the market. The goal is to influence other traders' behavior and profit from their actions. How does it work? Imagine pushing a snowball down a hill. The HFT system initiates a series of trades to create the illusion of strong buying or selling. Other market participants, seeing this activity, react by following the apparent trend. Once the market moves in the desired direction, the strategy closes its positions, locking in profits. While effective, this approach can be controversial. Regulators closely monitor momentum ignition to ensure it doesn't cross the line into market manipulation. Still, it highlights how traders use speed and psychology together to shape outcomes. High-frequency trading is a complex world, and these strategies only scratch the surface. Each one requires precision, advanced technology, and constant adaptation. Understanding them is key to grasping how HFT firms operate. Key benefits of high-frequency trading. High-frequency trading, HFT, has transformed financial markets by harnessing speed and technology to improve trading practices. Beyond its profitability potential, HFT plays a significant role in shaping how financial markets operate efficiently. Let's explore some of the key benefits that HFT brings to the table. Liquidity provision. One of the standout contributions of HFT is its ability to boost market liquidity. By placing and canceling thousands of orders in seconds, HFT firms ensure the market is constantly supplied with buy and sell options. More liquidity means it's easier for traders to execute large orders without waiting for a matching counterparty. It reduces the risk of slippage, the difference between the expected price and the actual price of a trade. Additionally, this liquidity narrows bid-ask spreads, making trading less expensive for everyone involved. Why does this matter? Imagine a busy farmer's market. If one vendor runs out of apples, others quickly fill the gap, keeping prices stable. In financial markets, HFT firms act like those vendors. They ensure there are always enough buyers and sellers, so prices stay balanced. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.